Hello everyone and welcome to the channel, or welcome back if you've been here before. I'm Kingdom Silver, and today we're going to get out of the silver talk for a little bit, and we are going to be talking about NCUA and FDIC insurance, and in the incredible words of Inigo Montoya, why people keep using that word, but I don't think it means what you think it means. All that and more coming up shortly. Sit back, relax, and enjoy the rest of the video. Thank you so much for checking out this channel. I really appreciate it. And just to clarify something right off the bat, I am a CPA and I work at a financial institution. In fact, I've worked at several financial institutions over the course of my career. Also, I do my banking at a credit union. In addition, I don't like making content that scares people, and I really hope this doesn't scare you. In fact, I think the goal of this really is to give you knowledge being power, and to provide hope of your assets being secured. With all that being said, we're going to dive into this topic, and we're going to be covering several articles today. The first one being from Wallet Hub, and this just kind of gives us a general overview of what that insurance is. So FDIC is for banks, NCUA is for credit unions, and they both insure deposits up to $250,000. Now below here, they have details by account category, and it gets into what the NCUA covers, what FDIC covers. I think it's a good article. I'm going to have it and a few others in the description of this video. I'll let you dive into further detail. Why I think this is important to cover this topic is a lot of people think that, hey, my money's insured by the NCUA. It's insured by FDIC up to $250,000. And for a lot of Americans, that's all you need. In fact, a lot of us would love to even get up to $250,001, right, in our bank account and risk that $1 not being insured. But really, ladies and gentlemen, how secure is your money? So I like to think of it a little bit like this. And we're going to jump actually to the FDIC's website. And something important that you may not know, and it's called the historical designated reserve ratio. So if you want to think about it, the FDIC is the insurance company for all the banks. The FDIC is betting on the fact that banks aren't going to fail. Banks are covered by the FDIC so that if they do get in trouble, they know that their deposits are covered. Think about it, maybe for someone that has, let's say, State Farm. You have homeowners insurance, you have car insurance, life insurance. State Farm is betting on the fact with the premiums that they charge you that you're not going to have significant problems, and because of that, they're going to make money. There's nothing wrong with that. That's just how their business operates. You, on the other hand, are betting that something could happen, or maybe not even that. You just want peace of mind that if something did happen, a wreck, God forbid something happening to your family or to you, needing long-term medical care, something happening to your house, live in tornado country here in the Midwest, God forbid a tornado comes through, that you have coverage so that you're just not left with nothing. That's really what the FDIC is doing. And how they manage this is through this historical designated reserve ratio. And as of 2023, that's at 2%. Why is this important? Well, if we think back to not very long ago, 2023, actually right around this time, give or take a month, last year, we had Silicon Valley and a couple of other large banks fall. And I probably said silicone instead of silicon. I realized this, correcting that. Silicon Valley Bank, that they failed. Well, it was around this time last year that Silicon Valley Bank, sorry guys, can't pronounce it tonight, failed, and I believe one or two other banks as well. During that time, those banks would have used up this designated reserve ratio because those were very large banks. Now, do I know that for 100% confidence? No, I sure don't. But just putting two and two together, I think you can get there. What this designated reserve ratio is saying is that for all banks that are part of the FDIC, they are reserving 2% of all those banks' deposits. Well, if 3 of those big banks fail, this is really what FDIC insurance works great for, is those mom and pop banks, those regional banks. However, you get into the super regional and the massive banks like Bank of America. This designated reserve ratio, ladies and gentlemen, isn't going to cover it. And in fact, at that time, what actually should have happened is, because if you remember, the Federal Reserve Bank and those that are the head of our policy making actually guaranteed the deposits even past what the FDIC could guarantee. Why did they do that? Well, if we go look at something very important, the Dodd-Frank Act. And what happened during this is bail-ins, bank bail-ins. And we're going to cover that in this Fortune article in just a second. What happened is during the Dodd-Frank Act, getting down here to it, that happened in 2010. It was the Dodd-Frank Wall Street Reform and Consumer Protection Act. This was a response to the financial crisis of 07-08, when you had large banks, there was issues with the real estate markets, et cetera, et cetera. They, instead of having the taxpayers bail out these big banks, opted to put in bail-ins. Well, what is a bail-in? Instead of relief funds, as we can see in this second line of the article, the second paragraph, that instead of relief funds coming from outside taxpayers, the funds came from inside shareholders and depositors. So what this tells us, and again, there's some restrictions on when you can use bank bailouts as opposed to bail-ins that's covered in this article. What we can see is that during this time, a year ago, there probably should have been some bank bail-ins as opposed to the government guaranteeing the FDIC. Because we can see by law, that's probably what should have happened. Now, again, I'm not a lawyer, so I may be misinterpreting that. Love somebody to correct me in the comments if I'm wrong. However, from me looking at this topic and interpreting it, that's what I believe should have happened. Why didn't it? Well, in a bail-in scenario, those shareholders or depositors in the bank are given shares of stock in that bank, and their deposits are seized to help pay debts of the bank. Well, that's great because it doesn't impact the taxpayers. However, let me paint you a scenario. If a bank falls and it fails, and I'm giving stock in that bank, is that going to be worth anything? Why would other people want to pay me for shares in that bank? It's clearly in trouble because they had to do a bail-in. Doesn't make any sense. So really, those depositors and shareholders, they're just out of luck. Why did the government not do this? Let me offer a theory. If they would have, then it would have caused a run on the banks because people would have lost confidence in this system. And then we really would have seen a financial collapse, ladies and gentlemen. So, that's great the government guaranteed it. But the government's trillions upon trillions in debt. I don't even know what it's at now. I think it could be anywhere from 34 to 38 trillion. So they guarantee that. What does that mean? They're giving money. They're printing money. What does that do? It rises. It increases inflation. The system, ladies and gentlemen, it's not in great shape. Now you say, well, Kingdom Silver, you work at a bank. You work at a financial institution. Why are you saying this? I do. And I do my banking at a credit union. And I believe that there are good institutions. There are people that are really making a difference, and they want to help people. I don't believe that all banks and credit unions are evil. However, I do believe there's some bad players. And I do believe overall that the system is messed up. So, what happens if in a couple months, let's say, a year, we have another couple round of banks fall? And what if the government decides not to cover them? Or even if they do, either you're going to have inflation go up, or you're going to have people panic on the banks. That's kind of what I see. Now again, this video isn't meant to make you panic, ladies and gentlemen. It's to give you knowledge, because knowledge is power. And my goal with all my videos is to provide encouragement and hope, to provide you another avenue. So, let me be clear. This is not personal financial advice. While I am a CPA, I'm not a licensed personal financial advisor. I don't know your situation. So, talk to your friends, your loved ones, your family. Hopefully that's the same people. But more importantly, talk to a licensed personal financial advisor and make the decision that's best for you and your family. With all that said, all I can do is tell you what I've done. And while I do still bank, I still do my daily transactions at a credit union. I do have a portion of my assets in silver and gold. I also have a portion of my assets in digital silver and gold because I believe we are a digital society and you're going to need to be able to use gold and silver digitally. That's what I'm doing. I find it funny because you hear preach so much in the financial industry. It's good to diversify your assets. You hear this in investing all the time. Invest in the S&P 500, in the NASDAQ, in the Dow Jones, in these big indexes. Spread out your risk. But yet, we put all of our money in a bank or a credit union or another financial institution. That doesn't make sense to me. You should diversify, and I think that should include where you put your deposits as well. However, again, this is not personal financial advice. This is to give you clarity on what FDIC insurance is, what bank bail-ins are, what that historical designated reserve ratio is. Might have gotten that all right even. And to take that information and make what decisions are the best for you and your family. With that, we're going to end the video because this has been long enough already. I appreciate those that have stuck it out to the end. Be blessed. Be a blessing to others. We'll see you later.